All right. Fantastic. All right, man. Well, I'm really glad you offered to do this. It's definitely not expected. So I really appreciate your time. Um, and I'll be happy to ask some questions along the way. I get pretty involved with this kind of stuff. So
Yeah, absolutely. Feel
I
feel
really, I
free.
really appreciate it, man. Hopefully I can ask some questions that other people might be afraid to ask. I imagine that it's kind of intimidating talking to a guy that, manages money. So if there's any kind of random questions, especially if I probably already know the answer to some of it,
That's
um,
totally fine, man. That's what we're here to do.
but I know a lot of people don't speak in the same language. So if I ask some random questions along the way, just bear with me, okay?
Nope, that's fine. If I ever need to explain anything like it's five or like you're five, just I'll do my best.
Hey, fantastic. I
Definitely,
love it.
when we get to the later parts of the night's discussion, I'm just gonna go and hopefully things make sense and people are gonna connect the dots. But it's gonna be a
Absolutely.
it's gonna be a deep one.
Hey, that'll work, man. Well, I'm gonna go ahead and mute. I'll let you kick it off, and you should be able to share your screen whenever you like, if you want to
Absolutely.
do that. All right.
All right. Well, thank you. I appreciate it. Welcome everyone. Thanks for having me, Alan. It's a pleasure. After our last meeting that we had, I kind of realized that I need to step it up and get back on Twitter more and get back to the education side. I've been super busy, not only at the firm that I'm at, but also launching a hedge fund alongside of another partner and a few other people looking to have that up and running in the next coming months, which is really exciting. So unfortunately, that's been taking up a lot of my time, but hopefully, as all that stuff comes to fruition, we're able to get back on track here and get back to educating. Thank you again, Alan, for having me. Pleasure and honor to be here. So let's kind of get back into things here. So, we had an absolute ripping market today in the midst of our overall long-term bear market. And I personally feel that we need to bring back the bears. So with the S&P up some what 2.7% on the day, first question you kind of got to ask yourself is the rally sustainable to any degree? And one of the things I'd like to point out right off the bat is when I look at markets like this and we get these bear market rallies, and of course it can turn into something bigger to the upside. We all know it's possible, but alas, I like to look at markets like this and try to figure out what's wrong with the picture that we're looking at. You can go down a watch list if you have one and look through kind of the usual suspects. And the S&P is up 100 points, Nasdaq up 300, doing pretty well. And although there's some breaking news out of Meta, actually, formerly known as Facebook, Meta came out today with a settlement forcing its continued downcline of 4%. And man, Alan, I know I think you've made some post about Facebook a while back, and man, they just cannot catch a break at all. They are just on a steep, steady downcline. Um, Anyways, if you're going down the list and looking at, what's kind of standing out in the world of investing and have been around for a while, and looking at the VIX did nothing today. Um, what happened with volatility futures? Nothing, and it just doesn't feel right. And when I say bring back the bears, this is an indicative of an absolutely more bear market rally than anything else. It's, in my opinion, it's not anything substantial as far as a move back to the upside, recession over, market crash over. In my opinion, it is just one big bull market rally. So I wouldn't get too hoped up, hyped up that everything's coming back, everything's gonna be okay, and all these other things. Um, in my opinion, what the volatility futures are really saying though is that it's a rally, but we don't really want to buy at this point. The rally is probably short covering. No one's really running out and saying, "Oh man, let's go buy Apple stock today or Microsoft stock today." It's tough out in the marketplaces at this point, and people are super skeptical. And if you don't believe me, that's fine. Just go look at the volume on the day. The volume in the S&Ps, which was almost 1.4 million today, people think that's high, except that included Sunday night, that included all day Monday's trading, and then it included today. So overall, what is the volume? It's really, really low. It's one of those things you have to focus on and pay attention to. And at this time, it's nothing more than a bear market rally and should be treated as such. In fact, even if you go look at volatility itself, we're actually in a very mild backwardation on the VIX futures. Um, that is the 29-day expiration VIX VIX futures are trading at 30.15, which are higher than the 57-day VIX volatility futures right at 30, which is still rather intense volatility, you know, projecting 57 days out. I think right now, all the way out to October, even, we're still up in the 30s on volatility, which is not a good thing for the markets right now. Another thing to be paying attention to in the marketplace is the energy sector. Follow it and follow it closely, because when energy sector lately is moving, you know, this is a 5% move today, which is extraordinary. You can't discount these moves. The S&P is right from the get-go this morning. Energy was up and sustained the marketplace. There was only a glimmer of energy backing off, but you need to watch it on a day like today, because it's tough to have wicked reversal on an intraday basis when energy is this strong. Again, a lot of people discount it, but you shouldn't, because the sector is now filled with mega market caps. The energy sector is no longer what it was a year ago. Some of, you know, the general, so to speak, or the captains of the energy sector leading the way inside have fallen a bit, you know, on the recent pullback of crude, but they're still leading the way and remaining very, very strong and heavy weighted in terms of market caps within the overall marketplace.
Hey, RPS, what are some of the biggest names that you focus on in the energy sector?
I tend to watch the actual energy sector ETF, so that's going to be your XLE.
Right.
As far as individual companies, you have your things like Exxon, Chevron, BP. There's a couple different oil mining companies out there that are pretty large. I tend to just watch crude oil, but it's important to kind of, because crude oil doesn't directly correlate back into the marketplace on a one-to-one basis. The crude oil futures are then going to affect the crude oil-based companies that are listed, which are then going to go, you know, into the ETF that are, you know, ETF is then purchased by other ETFs in the overall marketplace and is going to drive it which way or another. But I'd say Exxon and Chevron are kind of the two prominent ones if you don't want to have, you know, a watch list of 50 different companies that you may glance at from here and there.
Perfect. Thank you.
Yep. And then, you know, we have another aspect to dive into here, and it doesn't really unfortunately, as traders, you want to think that you're right, and you want to have all these thoughts and convictions, so on and so forth. But, you know, at this point in the midst of volatility, you know, the volatility that we have going on, what you think, it doesn't really matter anymore. The thing of critical importance is to really understand volatility, is to stop trying to handicap what you think is going to happen on a day-to-day basis. You are traders, just trade what you were given. Quit trying to do all this additive work. And I see it happen a lot, and it's almost pointless. You're not going to win. You really won't. It's all about risk reward, understanding the volatility within the market, and making assumptions and looking at things such that of bonds and seeing the cracks in them. If you don't, you're going to be in a very, very rough position for the coming 6, 8, 9 months, if not even longer. Bonds are actually starting to turn south again over on ZB, which is the 30-year bond. You have TNX, you have TNT, which are bonds. And when bonds start turning south again and start to break, that's going to drag the market back with it, causing tech to begin to sell again. For those who don't know, tech companies, mostly comprised in the NASDAQ and still pretty heavily weighted within the S&P, they rely heavily on debt and bonds and all these other things. And then I'll go on that a little bit further. As interest rates rise, it causes the price of bonds to go down, and it's the cycle that we're going to get into later a bit, so I won't go too deep into it now. But that's a very 300-foot view of kind of how that works. It's like a teeter-totter. As yields go up, bonds go down, and vice versa. And then in the overall side, there's so many problems within the marketplace, and none of them have been fixed, and arguably there's really hasn't been much of an attempt to even fix them at this point. But in either case, it's what we have to deal with. Now, it's not to say we won't continue this rally a bit, for the next couple days. maybe even into next week. But we have some headwinds later for us because, we hear from Powell tomorrow. And correct me if I'm wrong, but I think there's testimony coming from him both tomorrow and Thursday, I believe.
Yeah, I believe you're right.
Yeah, okay. And then,
I'd have to look at the schedule again, but yeah,
yeah,
definitely
so
more than once.
yeah, so tomorrow and Thursday, we're gonna stick with that for now. And I think it's gonna be pretty hostile out in the marketplace. And speaking of hostility, if you go look at the advanced decline line in the marketplace, it's pretty pegged today with a high correlation, which is indicative of the entire market trading as one unit to the upside rally that we saw, which does not feel like it's going to end well, and in my opinion, kind of correlates everything back to it being a bull market rally. Because nothing's changed. We have, I think it was 89 companies. We're green today, and then 11 were red. Everyone coming in at once. It's just a rally, in my opinion. It's not this, 50-50 or 60-40 balance moving the markets back to the upside. It's all at once, and it's all as a team, and then it's just going to snap back. Outside of bonds, and volatility, there's some other things, of course, that are bothersome. I'm sure you guys are kind of sick of hearing them, but at this point, if you look at the SPX, the mother of all products, you have 3 recent breaches of expected moves, and it's not the matter that we breached it, it's that it's several 2 sigma moves outside of the expected moves. Sigma is just standard deviation based on a set number, and it's moved, standard deviations outside of it. What I'm saying by that is that we can look back about huge amounts of data back to COVID crash of 2008, 2000, so on and so forth. But one of the things that's kind of bothersome about all of this at this point in time is not necessarily, the number of breaches of the expected move. It's the magnitude of the breaches in terms of what's expected. One of the things I try to track as best I can is the breaches of these expected moves, and they often lead to more and more breaches of expected moves. The question kind of becomes is how can the SPX be getting it so wrong all the time and keep having these breaches? It almost feels as if there's a very quantitative aspect in there, and I'll get to it a little bit. But the marketplace is just genuinely getting it wrong. In terms of SPX volatility, it feels suppressed, and what it tells me is that there's probably going to be a number of traders presently selling premium out in the marketplace, and they're doing it in a very short duration. And the problem kind of becomes with that is that when you're selling premium in the short duration, and instead of having, for instance, a $100 expected move, we move $200, and you get yourself a problem, and then it happens again and again and again. However, volatility correlated back into that doesn't seem right for the type of price action we're seeing. This entire week here, the week of 20th, 21st, has an entire expected move of plus or minus $120. We almost hit that already today. And this is only the first day of the trading week, and we have 3 days left. So either we're going to make Sigma moves outside of this expected $120 range. 2, we are going to trade damn near flat the next 3 days. Or 3, we're going to complete the Sigma move or the standard deviation move back to the other side of the EM range. So what does that look like? Well, it's a 240 point swing back in the other direction.
So let me ask you this, just based off of that, for the other people listening, how did you come up with the expected move? And how did you, and when you say a $120 swing, like as far as a weekly movement, are you saying a net $12 move on SPY, or are we saying literally from the change in last week, the delta going up or down in price by $12?
Okay, one, or I'll get back to the expected move side. I'll answer the second part of that question first. So So say the S&P is closed at 400 on Friday evening.
Right.
You can find this in the options chain on the expected move, but whenever you look at the next week, there will be a plus or minus, and it'll have a dollar amount. What that is telling you is there is an expected move based on options calculations that there will be a plus or minus a $10 move for that entire week to the upside and or to the downside. So S&P will go either from 400 to 410, or it will go down to 390, and it will stay somewhere within that dollar range. It'll stay within that expected range typically and generally.
Perfect. That's what I was asking exactly. Okay.
Yep. And then the first part of that, it's a mathematical calculation. If you want to do it by hand, that's fine. It does tell you on Thinkorswim. But the calculation is, the expected move is equal to price of underlying times implied volatility times the square root of number of days divided by 365.25. Visualize that and have fun.
I think people can write that down. That's not that hard of an equation.
Yeah, I'll say it again.
Yeah.
For those who missed it, it's price of underlying times implied volatility times the square root of number of days divided by 365.25. And we've already hit this, well, I guess we're 20 bucks away, 2 points on the S&P on SPY. We've only got 3 days left, and we're pretty much hitting this off the bat. There's billions and billions of dollars being traded in the options market. So, expected move really isn't a fictitious beast. It's very literally based on billions and billions of dollars being traded within the options market. Bothersome part in that is a situation like this when there are a lot shorter duration premium selling going on and the market continues to breach is what is that issue is that the volatility seems low for what's going on. The skew as well seems very, very low at 121. It's very scary low, and it keeps looking like we've got short duration premium selling going on and getting torn apart, but they just keep coming back for more and more. And if they were buying the volatility, like I know a lot of traders do, we would be going up in the VVIX or VIX. That's not what we're happening, and it isn't, and the VVIX isn't transpiring with that, which is really why I think there's a lot of premium selling going on. The skew isn't high enough for this. There's not enough hedging activity going on. These factors don't really fare well moving forward in the market, and it's going to catch a mass number of premium sellers in the short term with their pants down, unfortunately. It kind of comes back to, for those of you who speak Greek, JP Morgan, for example, has a collar trade going on right now around the, what was it? The 363 level, and they're running credit spreads at 363, I believe it is, or 360, one of those two. And then they've gone out and sold the 340 puts and sold 380 calls. So whenever you look at it from the opposite side of that, well, who's going to facilitate a JP Morgan options collar trade? Well, there's not many people out there. It's going to have to rely on a market maker, another institution, most likely a market maker in the case of JP Morgan's trade. And so what happens whenever you get down to those levels, like we did on, did we get there Friday, I believe? Yeah, we got down there on Friday, is the market makers have to then go in and start buying stocks to hedge their position so they're gamma and delta neutral, and it becomes this kind of back and forth game. However, fortunately, for the bears out there with long dated short positions, those options expire next Friday or next Thursday, or it's got to be next Friday. And after that, we could see some more downside if we don't see any more chop. Contrary to that, though, if we do start to break down past that 363, 360 level, and they aren't able to come in and neutralize their gamma exposure, that gamma will then compound to the downside, and it's going to be an absolute shit show of a spiral downward. Questions? Gonna pause here for just a second.
I think that's pretty good. I don't really want to go into the specifics of what these credit spreads are. I think people can look at that stuff on their own. But that's really interesting, especially about Chase. I like that.
So in the short term, I I don't see necessarily huge moves. And if they are huge moves, I think they're just kind of going to be some range bound moves. Overall broader market, with what's going on, if we take, a bigger step back, pull your charts back out to the 4-hour chart, the 1-day chart, whatever you have to do, quit looking at the 1 minute or 5 minute, and don't get trapped into this shit. It's
Can we talk about that for a second?
Yeah.
Because I'm a part of a lot of discords, a lot of groups, I have conversations daily where people are following these internet personalities into some really high risk trades. And they spend most of their time on the one, anywhere from the 1 to the 15-minute chart. Can you tell us a little bit about your experience and what you look at, in your prep for the trading day, as well as what you look at intraday? I mean, obviously, if you're going to take a trade, you're probably not going to do it on the 1 minute or the 1 day, right? But can you tell us a little bit about your experience with that?
Yeah, so it really comes down to what kind of trader you are, unfortunately. There's no right answer and there's no wrong answer.
Sure.
If you're a swing trader, you want to be looking at those 30-minute, 45-minute, 4-hour charts, even maybe, the daily charts if you're going to throw on, some leap options or, hold it in a tactical trading allocation portfolio for 1 to 3 months looking out. You don't necessarily want to be looking at a 5-minute chart whenever you're trying to make a decision for projecting 1 to 3 months out. So, that 15-minute, that 4-hour chart. Actually, I wouldn't even say the 15-minute. I would really just stick to the 4-hour daily chart if you're looking at anything past 2 weeks. If you're looking to hold something for 2 weeks or so and have a short-term swing position, that's when you start looking at your 15 and 30 minutes and maximum 4 hours.
So let me ask you this. I think because of the groups that I'm a part of, I guess more specifically, I think a lot of these people are used to looking at either a day trade or maybe a 1 or 2 day swing. Unfortunately, I don't see a whole lot of people talking about leaps. I don't see a whole lot of people looking at the broader range time frame.
Which is unfortunate.
Right. Okay. So let me ask you this. So what's the typical return, assuming your bet and your analysis is correct? What's the typical return on a 3-month position like that?
Like for me?
Yeah, sure. Average. I mean,
if we're just talking like projected targets over what's actually been achieved, a projected target over of a return for something like that. Of course, this is all depending on the percentage of allocation that's been made. But
right.
Generally speaking, we're going to look for a 5 to 7% return on that time frame.
Okay.
We're not sitting here shooting for 50%, 100%, any of these things.
Would you say that's a pretty common mentality from people that have been in the industry longer?
Like shooting for those targets?
Yeah, I mean, obviously, what's really gotten a hold of people lately has been these 100% plus returns, day trades. They think, oh, I could put $1,000 on this and make $1,000 in 10 minutes.
Yeah, and that's not realistic at all.
Okay, so that's kind of where the mentality I was hoping to get from you.
Yes.
So somebody who's been doing this for a while, that's successful, they can turn 4 figures into 7, no problem. Like I was hoping to.
Longevity.
This is exactly what I was trying to hear. Yeah.
Yeah, it is all about longevity. If you want to survive in the stock market, you gotta look at it from a longevity point. You have to start understanding risk reward. You have to start managing your emotions. You have to start managing your positions. You have to be willing to just let go of positions. Understand that you aren't going to be 100% right. It's not possible. I'm not 100% right. Alan's not 100% right. Warren Buffett's not 100% right. Nobody is. So understanding that, yes, positions are going to go against you, but your risk management skills, whenever you take that loss of, say 10, 15%, but then also being comfortable taking profits on the same, position, position sizing, which is another thing you should be doing. You don't want to be going heavier into one position than another. You want to keep it equally allocated. We'll just use round numbers here. If you are running a 10% stop loss, let's just say you have $1,000 account and you put $500 into 2 trades. You lose 5 to 10% on another trade, and you make 20% to 30% on another trade. So your win rate is 1 to 1. You have a 50% win rate, but you profited so much more on your winner because you just took profits and let it be, but you also risk managed and kept the losses that you were taking very small and very minimal. And so many people in the Discord and Twitter space try and basically measure dicks for the biggest and largest win rate and win percentage over time. I don't care about your win rate. I want to see your average trade or average dollar cost gain per trade versus your average loss per trade. That is what's going to
And
be important at the end of the day.
that's honestly one of the biggest things that I've been trying to get across. So when I was early on, I took a lot more risk.
Yep.
Right? Like shooting for this massive win. And then I would easily let a 20, 30, 50, 80% trade turn into like break even almost,
Right.
Because if you're taking more than one trade per day, like these people that say, oh, I made 20% on this, 100% on that. What really concerns me is that they're not aggregating that all together to get a net gain.
Right.
Like what was your net gain for the day? That's what I want to know.
Right. And
right, because if you're especially if you're a day trader, but even more so as a swing trader, you have to be a lot more stoic. You have to
it's not
be,
even net gain per day.
Right?
Yeah, it's not even net gain per day. I don't care if you made $3 one day, $10 another. But if you made 3 one day and 10 another, but one of those trades was because you made 10 and then risk managed on another position and kept and lost 7, but you still netted 3. The next day you make another 10. You made 13 on a trade, and then you lost 3 on another. Managing these positions and boosting that winning trade dollar versus that losing trade dollar amount is going to launch people accounts into the fucking stratosphere. It really will. I think in
appreciate you saying that.
Yeah, I think in the Twitter space, it's almost like think of it kind of like, have you ever seen the like dieting commercials and like the old P90X things?
Oh yeah.
You know what I'm talking about? Yeah, so like they post all these things, if you just work out for 30 to 60 days, you're gonna be ripped and have the 6-pack abs and have huge shoulders, all these other things. What they don't tell you is that they've been doing the same system for 4 to 6 years. They've been on a very strict diet. They've been on a strict diet. They've done all these other things in the background. And I think for a lot of new traders, they come in, they see these 100% things and all this other stuff, and they're like, oh my God, I can do this. What they don't see is the person that they're following has put in hours and hours of work. If that person's even legitimate, we can get into that later if you want, but
I would rather just stay positive because
yeah.
I mean, I think one of the biggest things, so like just to let you know, like what my mission has been since I came online was I see a lot of posts, a lot of like, people with 100,000 followers, just blubbering bullshit. And
oh yeah.
And I hate that, because the average person that comes into this is already broke. That's the whole entire reason they're doing it. Like they want to change their life for the better. And I would hate to see them make 100% on a trade and then lose the next 10 because they weren't taught how to use risk management or when to take profits, or they're using a high risk strategy that's on a very, very short term basis, and they see 30 seconds they can see 30 to 40%. But what happens if you get it wrong? Are you going to cut? Are you going to what are you going to do? Are you just going to hold it and pray, or what are you going to, so the whole point has been trying to spread quality information from people that have been doing it and made a career out of it. Right.
Yeah, and it's really hard to do.
That's one of the main things I want to see people. I want to see them succeed.
Yeah, and I think it's difficult for a lot of traders who do find people who go out and find their person. so to speak, that they want to listen and follow to. And you see all these things. I've even had people come up to me, or I guess reach out, all these other things, and they're like, how do you do this and all these other things? And it's like, I can tell you exactly how I've done it, and I can promise you you'll never be able to do it because you can't do it the same way I did. We all have our own process to go through. And a lot of times what people don't realize is, well, one, this isn't something that's going to happen overnight. I have clocked nearly 25,000 hours of screen time doing this. So trying to be necessarily like me with 25,000 hours of experience into this, and then you're over here with 100 hours who has watched 10 YouTube videos and taken your first option trade or futures trade, whatever, you're not going to be able to produce the same results. It's just not going to happen. There's things that just take time. you know this is no different than going to school and getting a medical degree or even a bachelor's degree. The route for a lot of people that go into the investment advisory scene or go work for the big banks or hedge funds, so on and so forth, you go to college for 4 years minimum. You get a bachelor's degree in computer engineering, finance, economics, whatever. From there, you can go and start off as a low-level analyst at a fund or a bank, or go start off at your broker dealer, whatever. From there, you're then either going to go back and get your master's to move up in the position, or you're going to be stuck as a low-level junior analyst. You'll probably intern for a year, and then you'll become a junior analyst for another 1 to 2 years. Then you may get bumped up to a senior analyst for another 2 to 3 years. Then you'll be a trader on the trade team. By the time you're actually managing a portfolio at a bank or a fund, generally speaking, is not for 12 years of experience into this. I'd say 8 to 12, generally speaking, under most circumstances. So for people to come in and think that they are going to manage and their own money and make tens of thousands of dollars, hundreds of thousands of dollars with 3 months in the market, you're insane. And I'm not trying to discourage people by saying that and ruin hopes and dreams here, but you have to look at it from the bigger picture. You're not going to get rich quick. So there's people who argue with me about that all day long, and I guarantee I'll win the argument. Someone will get lucky somewhere. It always happens. If you get lucky, congratulations. I'm proud of you. Happy for you. You'll probably be broke in a few years anyways, because you don't know proper risk management, and you're going to go blow your money on models, Lambos, Rolexes, and stupid shit. You're going to be right back where you were 5 years ago.
Well,
So,
that's what it's all about, right? Like you and I both. I understand we have different goals, right?
right.
But what I'll say is that like we're both at the end of the day trying to teach people. Like I have 15 years of experience in the market. You have obviously plenty, and you're a professional at this. And I want like my entire goal and what I was hoping for, and I'm really glad we're doing this, is just for people to understand a realistic point of view. I don't feel like we have to be so outlandish with our finances on this stuff, Like if you compound your wins and you use proper risk management and you focus on a healthy return on your options betting or whatever you may be doing,
Yeah.
I think, just from my experience, in the long term, you're going to be okay.
Yeah. I mean, let's say with like a $10,000 options account, or even make it $1,000. I would venture to say 5% a month is pretty reasonable trading options. Would you say that's kind of fair?
Mhm.
Or maybe even more than that,
So
depend.
when I first started, this was 6 months ago. I opened this account. I had 50 grand in it, and within 2 weeks, I was down 60% of my money.
Mm-hmm.
I had only done common shares before. I'd never done options, but I've been around it so long. I was like, you know what? I got this. Well, then I started picking options expiries that were too close, too soon. And my thesis would always end up panning out because I'm a good analyst and I'm a good trader. I have natural talent to this. Like, this is what I do. And recently I went full time. But I was down 60% within 2 weeks
Right.
trading options. And it was a huge reality check. I turned off my computer. I walked away for a while and I was like, you know what? I'm not ever taking these kind of risks again. So I had to come up with my own system that would guarantee me profits every day and not, wait for a EMA close below the line to take a 40% loss on a weekly, options, contract. Like
Right.
I had to really start managing my money because if I wanted to do this and I wanted to start a business eventually helping people, which, is something I want to do next year, I have to be able to show longevity. I have to be able to show that I'm able to survive in a market that's probably one of the hardest markets to trade in, this year. It's very, very difficult, like people take it for granted. And the truth is that most of the people you see online, the internet people, they're probably in their early 20s, been trading since COVID started, and they think
I'd
that
put money
they
on
got
it.
this
Almost all of
shit.
them have.
Yeah, well, you know what I'm saying? Like I hear a lot of the stories, and even the people that have a natural take to it, the ones that are really starting to get really popular. I mean, even the guys in King Cap are all in their early 20s. Like I'm not saying anything bad about them at all. I think that if you have a natural knack for it, you're probably not telling your followers everything you're doing. Because if all you're showing is these 100%, these baggers, these, doubling your money every day type of things, man, like that's not realistic. And it's definitely not realistic over the longer time frame, right?
No, I look, if people were truly doing the things that, they'll screenshot and say they're doing, just run a simple Excel model on it. Does not
Right.
add up, does not make sense. I can tell you from personal experience looking at the strategies that a lot of people run, they're not scalable at all. You're
What do you mean by that for the people that don't know?
Yeah, so scalability within a strategy, it's very important. You know, you're not going to be trading, hundreds of thousands or millions of dollars with, some EMA crosses and things like that. It's not gonna happen. Whenever you get up to that level of trading, you be you'll inherently become inducted into this world of other people. You'll see it when you get there, and it's just gonna happen. Um, and you learn things, and you learn how money works, and you start to truly understand what the market's saying and what it's doing, and how to position yourself to do certain things. And you can run whatever strategy you want to make money, but most strategies that are out there being taught are not going to carry you to a million, 5 million, 10 million, at least relatively within your lifetime. It's not gonna happen. They're okay strategies, don't get me wrong, but at the same time they're also bullshit. They truly are.
Well, so here's my question. The EMA crossover, the let's see, you got the 10 and the 50 moving average on the 30-minute time frame. That's another guy's system.
Yeah.
You got just playing the levels,
Yeah,
scalping between two levels, right? There's a lot of different things that are being talked about. So let me ask you this, because obviously I'm new to the options game, right? I'm always trying to learn. Like I am the first one to shut the fuck up and listen when it comes to this kind of stuff. So I guess my question would be, you obviously developed the quote unquote dirty 30 strategy, or at least allowed it to be broadcasted to the world, right?
I wouldn't say it loud,
Um,
but yeah.
well, whatever,
Yeah.
I'm not
No,
trying to get into all
I
that.
know. Yeah, I know.
I mean, you know your stuff, man. There's no doubt.
Another time.
Um, yeah, no, but I guess my question would be like, why is that effective then? If all strategies like that are not really inherently unique, I mean, obviously you have a different way of looking at the markets.
Yeah, so let's just take the 30/30 and let's just take that out of the strategy. Okay. Supply and demand. What runs the world? What creates prices for everything? You know, it is supply and it is demand. Why is oil so high? We don't have enough supply and we don't have enough demand. What you're trying to do when trading a supply demand strategy from a very basic level is you are trying to catch it's basically a gap fill between where there was previous buyers wanting to buy and got left behind because the market ran too quickly, or sellers that were still wanting to sell and they got left behind too quickly. That is what you are trying to extrapolate on in the supply and demand theory, and it works very well. Supply and demand has been around for thousands of years. It is the one, I mean, I'd say the economic driving factor of like any economy. If you want to have any economy, that serves a currency system and then base its products off of a currency system, you have to have a supply of goods to then exchange for currency that the currency is then used in a demand capacity to buy back from that supply. And that supply then has to compete with the demand, and it's this evolving cycle that is forever churning.
That makes sense.
So yeah, I mean, you can trade supply and demand without the dirty 30. It's not required at all. I'd
I know.
almost
I don't know what all you wanted to cover tonight, but did you want to get any of these specifics at all,
of
or you
that,
just kind of wanted to
no,
like
we're gonna
cover a
do
little
that
bit more
another
macro
night.
level stuff tonight? Yeah.
Yeah, we'll do something else on the dirty 30. Um, I'll make another note at it towards the end of the video for those who stick around. Should have done it
No
at the
worries.
beginning to plug it, but whatever.
No worries.
We are doing a month-long futures trading challenge, led by myself in the month of July, where we're just strictly using that dirty 30 strategy. So for those of you who have made it to this point, thank you. We appreciate you. Alan, if you would, post a link in the description of the video. I'm sure he's more than happy to do that. And
yeah.
we're going to be using this entire strategy for 23 trading days straight. So come on, hop on, watch it, trade alongside of us if you want. Whether it's paper or real money, we're gonna be doing a live stream next Wednesday to get everything set up, and we're gonna have a blast and hopefully make a sizable chunk of money and kickstart people's trading careers. That is the plan for
Man,
that month.
I think that's going to be amazing. I think this is probably one of the most beneficial conversations to the newer trader before you can even start trading. I mean, honestly, like I studied finance in college. I got my finance degree. I've been
I'm
working in
sorry.
corporate accounting and corporate finance for a long time. Yeah, I know, me too. But I mean, like, this is not something you can just master by following some Twitter personality.
No, and I mean,
Like,
even when you were going through your finance degree, you didn't have a mastery of CAGR or cost of goods sold. You didn't know how to extrapolate a
no,
model and forward project based off a balance sheet or an account statement. You didn't know how to run, forward projections on EBITDA or EBIT. You didn't know how to do any of those things yet.
right.
Even though you had a finance degree, you still have to go out and learn more.
Exactly.
You're not just going to be
And
a
to be
master
honest,
of it.
like it was, when you're doing your undergrad in college, and for a lot of the people that didn't study business or finance or anything like that, like you get a overview basically. Like it's not until you get into your career where you start learning how different companies handle things and how, even like just like pulling your assets for depreciation. You could simply pull them all together and depreciate the entire pool if you wanted to. Like you have no idea all the tricks that these big companies use to fluff up their income statement or the balance sheet or whatever. Like that stuff is not necessary for trading necessarily, but if I'm going to invest long term, like for instance, we're in a bear market, a lot of people are starting to look at what they want to hold long after this year.
Yep.
And it's like, well, how do you decide that? You just gonna watch CNBC and watch Jim Cramer lose his shit every day, or like,
So
what
here,
are you gonna do?
yeah, I mean, and here's a
So
little
that so
insight to
this is like
that.
a whole thing,
Yeah, and here's some kind of insight to that. Um, whenever you or people you've talked to look at the market right now, what is like the reaction that you see?
Well, I mean, everyday people, they think their 401ks are in the shit. They think, they don't know what to do. I know old people that thought they were ahead on the whole crypto madness, and they've held crypto since 2013, and they've made all this quote unquote money on it. And then now look, like, well, what are you gonna do? And they said, I just keep buying the dip, man. I just keep buying it.
Right?
Well, that might not be the best strategy. Maybe you should not live off prayers and dreams, Right? Maybe there's a better way.
Yeah. From the retail people that you've talked about, I guess is it people saying are we on a sell? Is everybody saying sell or is everybody saying buy? What are you seeing out currently in the market?
Outside of the FinTwit personalities, outside of Twitter, outside of in real life, when I have conversations with people, like,
No, even on Twitter.
well, on Twitter, it's mainly just trading. Like they don't really. A lot of them have no clue what to hold. They'll end up holding whatever their favorite personality
Forever.
says to hold.
Yeah.
Um, and it's not like they're talking to professionals, like, because the truth is that what I'm realizing is that a lot of people are just skeptics. They don't trust professionals in the industry. It's the same reason why you wouldn't trust a real estate agent right now to say, oh no, the market's hot as hell.
Right.
Like, no, yeah, you should totally buy.
Yeah. So
Well,
what are you
that's their
seeing out there?
job.
What's everybody saying right now? Kind of retail side, I guess.
I think
Outside
people
of
are. I
trading
think
FinTwit.
people are nervous. I think that a lot of people are expecting at this point, with how exponential and how fast things are escalating, especially with the Fed, that you know it's becoming more and more common to think that things are not priced in. Let's put it
Right.
that way. Like they think, okay, well, if it's priced in, why does the market jump 12 points every single time Powell gets on a microphone? You know what I'm saying?
I'll
So
actually I'm going to explain that later.
I think people are a little more realistic than what the TV media will tell you.
Yeah.
I think they're nervous. I think they don't know what the hell is going to happen. But hey, we learned how to buy a put option, so that's
Yeah.
good.
So,
You know what I mean? Like
on the
so.
S&P, we're down, 21.5% right now, year to date. Nasdaq's down 30%. Everyone's essentially come to the consensus of, sell, 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 buy puts,
Right.
for 3 months out, whatever it may be. Zoom out on your chart. Understand the potential of where we're going to go, but also keep in the back of your mind, we are a 30% fire sale from the all-time highs of the market.
Right.
If you zoom out, please, for the love of God, just zoom out. Go back to any financial crash. You won't be able to find this stuff, go back further than, 2000s or, sometimes the 90s and 80s. If you're using Thinkorswim, I think you can go back to the S&P in the 80s. TradingView, I think, only runs back, to the 90s or something. But zoom out on your chart. Go find me a time in history when the market pulled back 20, 30, 40, 50 plus percent and it didn't eventually come back and make new highs and continue to move upwards. Go find me a time, and the first person to find me a time that happened, I will give you as much money as you'd like. It's never happened.
Y'all heard the
man. Go find me a time that it
No,
never came back.
I'm well aware of the history of the markets myself personally,
Yeah.
but But
it's a 30%
it's
fire
hard.
sale.
It's hard to justify that kind of mentality. I think what a lot of people that I talk to anyway, you know, it's hard to justify the mentality because we've never had another time in history when we injected over $5 trillion into the system at once.
Right.
We never had another time in history when like you lock down the entire fucking world.
No, and I get that.
And there could be whatever opinions on that. I don't give a fuck.
Yeah.
But
Do we move to a depressionary period? Yes, it's very possible.
see, that's more where my head's at personally.
And
But
yeah, I would be inclined to say that, but at the same time,
at
as
least
we
a
get new
recession, if not
information,
depression. But I don't
yeah,
know.
I mean, we're already in a recession. I think the depression is going to come,
But
personally. But at the same time, even if we want to go back as far as 1929 and understand the banking financial collapse that happened then, the market still came back. Yes, it took 10, 15, well, it really took 15 years for that to happen. We kept moving back up, till 1938. We had an issue in 1938. 1940s, started World War II. We had an industrial boom, and inflation hit, 47, I believe it was, and we moved back down and really didn't break back through the highs until like 54 or so, maybe 50, 51 or 54. So yes, it took a long time to come back. Most people listening to this in 15 years are going to be mid to late 30s. If you're averaging down small allocations each time, very, very minuscule, average down into the QQQs if you want. I'm personally going to start building a position in TQQQ, which is 3x leverage NASDAQ
3x.
fund.
Yeah.
And I'm going to hold it for 5, 10, 15 years. I really don't give a shit. And let's just say we move at a steady pace from bottom to top, and it takes 10 years to go from bottom back to the all-time highs. You are averaging down. It is going to be cheaper and cheaper to buy shares for the same dollar amounts. I would run it in dollar amounts, don't run it in shares. But 200, $500 a month average in. As you are averaging down throughout this, the share price is going to get cheaper. You're going to be able to buy more shares for the amount of dollars. So say we take a 50% decline and you were to average from the top through that 50%. Hey, we've declined 50%. You've averaged throughout it. Most likely, if you've done it properly, your drop, your average is going to be at about that like 38 to 35% range. So the market doesn't even have to actually go all the way back up for you to profit on those shares. It only has to move up, another 7 to 10%, and you're back in profit because you've averaged down the whole time and have just stuck it out. And yes, it's going to take time. It's going to suck. It's going to hurt. Cool. Just step away. You don't have to watch it every single day. And that's more of a longer term portfolio perspective on things. And then from there, you're in a 3x leverage NASDAQ fund, in my example, and you are riding the profits back to the fucking glory days of 2020 and 2021 all-time highs. And you're in a 3x leverage NASDAQ fund. What's so bad about that? But you have to shift your perspective.
Right.
And it's difficult to do. I get it. I struggled with it for quite a while. It took me about 1.5 years to become consistently profitable. And I'll touch back actually on that from our earlier conversation of, risk reward and win-loss ratio. When I became profitable, I only had a 40% win rate whenever I first became profitable. But because I managed trades, cut my losses quick, and let my runners run based on a set defined rule system that I had and I didn't break, I was able to still be profitable even though I lost 60% of the time.
Right. So you're not the only person I hear that from. Like some of the people that I revere the most, Money Mender over here at KingCap, right? I believe he had like a 45% win rate.
Yep.
But the guy's making $20,000 a week.
Yeah.
Or a day or whatever it is. I can't remember now. But it's because He knows how to manage his risk. Right?
Yeah. Like for the new traders out there, I wouldn't even bother trying to come up with some strategy. Learn how to manage your risk, manage your emotions. Otherwise, you are going to be in this loop for a year, 2 years, 3 years, so on and so forth. And if you're lucky, you get out of it. Manage risk. Otherwise, all the work and time, effort you're putting in is kind of wasted in a sense. It's not entirely wasted because you're still learning, but
what's a practical way for them to go about learning that? I mean, do you think is a healthy stop loss 15-20% on any given trade?
so
Or,
you got to look at it from a risk reward standpoint. If you are, say you are running a 10% stop loss on your, so say you buying an option for $100 and you're willing to give up $10 to do that. Okay, well now you need to know that you need to make 20% whenever you win to come out ahead on that trade.
Right.
So you need to make,
the way people should be thinking about it, right?
Yeah, you don't need to have a huge win rate. Now you don't want to, lose 90% of the time, of course, but understanding that you're going to lose, accepting that you're going to lose, and being okay with losing is so important. I can't say it enough. You're going to lose. It's gonna happen. You're gonna probably blow up a couple accounts. Set rules for yourself. If the trade goes against you 10%, close it out. Don't sit here and wait and watch it go 15, 20, 30%. And then you're screwing everything up. There's going to be a lot of times in your trading career that sticking to these rules that that option contract is going to come back and run 400%, whatever. Who cares? Stick to your rules and stick to fine. Preserve the capital, build it up. It's going to take a while. It's not going to happen overnight. But with doing that and understanding risk, you're going to start to see things in the stock price because you're not going to want to lose. You're going to get pissed off that you lost in a trade and it ended up working out in your thesis in your favor. So it's going to be this thing that's going to happen. And almost everyone who's going to go through it, you will see this happen. You are going to go back. You're going to analyze your underlying asset. We're just going to say it's Apple. You're going to go back. You're going to look at Apple stock. You're going to see when you entered. You're going to see when it finally broke. And you're going to start seeing these different patterns, these different setups. All of those other things, what are they called? The you're gonna see like your descending triangles and all these other things, or you're gonna see a fib level or thing that you missed. You're gonna see a candle pattern. All these other things, you're gonna start to see them just by inherently trying to manage risk.
But that's also comes with screen time.
Yeah, you got to put in the time.
This is not a type of thing you can get into and go buy an options contract, come back after you're off work that day or lunchtime or whatever, and then be like, oh shit, I'm down 90%.
Yeah,
like,
no,
you can't do that. You can't do that,
Yeah. And do we want to kind of explain why you can't do that?
Please.
Yeah, so reason why you can't. So you can and you can't. And I'll give you why you can't. I'll give you why you can't first. Why you can't do that is because most of the people that you guys follow and listen to are selling very short-term options that have high implied volatility, especially in the market that we're in now. And theta is going to erode that contract if it doesn't move in your favor. The problem with buying options contracts is that even if you're right in picking a direction that it moves, you can still be wrong. That's why I hate buying options contracts.
I'm not gonna lie to you. Full disclosure, I posted yesterday about this, and one of the most discouraging things for me, I'm really good with analysis. I'm really good at figuring out what things are going to happen just based off the conversations that are going on. I can pretty much tell what's about to happen before it happens.
Yep.
But because I'm relatively new to options, and I say relatively new, I'm fucking new. I've only been doing it for 6 months, but I can buy a swing on a common stock, and it take a couple of days to play out, and then I get my move, right? But on an options contract, entry and exit is everything. You have to know when to buy. You have
Yeah.
to know you have to know when to get in.
Yeah.
And one of the things that I was struggling with, especially recently, was, you know, let's say the crypto market, for instance, right? I had this put position on some Riot puts, and then I watched Bitcoin tank night after night, and even over the weekend, it came back into demand. But I don't see that lasting personally. Um, and right now, I'm down like 30% on this swing play for a week out. Like, that was a risk that I was willing to take. Um, and I personally believe it'll play out the way I want it to. But as of right now, I'm losing that trade.
Right. And I think
And
what
and
people
it's
miss
like,
out whenever they first get into options, and you're sounds like you're starting to see it, is
yeah,
understanding what theta does to your contract.
oh, it's gnarly.
Theta it's an exponential curve. The closer, so it, I'm trying to think of how to draw it, but it's going to be hard. Just go pull up a chart of theta decay for options, and
Right.
it's an exponential curve. The farther out you are from expiration, you're not going to get ate up that much. As you get closer and closer, the daily moves that you're going to lose, cent or dollar value on the options contract is going to become exponential. That's why,
Right.
your option could have been for a 5% move to the upside, but in order to even break even based on the price of the option contract that you bought, you needed to move 5.05% to the upside to make profit on it. So you hit your 5% and it closes even on your strike, you lost money. You wanted to move 5%, it only moved 4.98%. You lost all of your money. It is
So
it's
with
buying
that,
contracts, and I think it's very dumb.
for especially since I'm trying to break this down a little bit further, when you enter an option play, is there an easy way for someone to know how much movement they're going to need to make a profit?
So
I mean, without some hardcore calculations, is there an easy way for someone to look at the data that's currently on that contract, the IV, the theta, the delta, whatever? Is there an easy way for them to understand, hey, this is how much I need this to move to make a profit?
yeah, so we'll just use round numbers. So say you have a stock that's trading at $100 even, and you go out and buy the 105 call for 20 cents.
Okay.
You need that stock to move 5.2%, so to 105.2 to break even, because you needed to hit your strike, and then you've also paid for the contract itself. So take your strike, add on your premium, that'll give you, your 105 and then your decimal points in this example. And then you can, run that. If you want a percentage, you can then, subtract and divide out to get your percentage of movement that you need to break even. Does that make sense?
Yeah.
Yeah, okay.
Sense.
Awesome.
Yeah. Feel free to keep going. This is great.
Yeah,
I'm
no.
really loving this because I think, especially the newer people, like they
And
don't
I'll
want to
hop
make
on
a
some
comment.
one-on-one time with you, by the
Yeah.
way, and help you.
Oh no, that'd be great. I think especially for the newer trader that's been doing this, let's just say for as long as I have, less than 6 months, whatever, you know, I think about as far as they dig in is, okay, I just need to make sure the momentum's in my favor before I enter a call or a put, right? Like, they don't, the newer trader is not going to be successful in a choppy market. The newer trader is not going to be successful when we're in a $2 range day on SPY or $3 range day, because they don't understand why certain stocks move when they move, or why SPY moves the way it does.
Right.
They just see, oh, this. I was told that this is a highly liquid contract. The spread is tight. I'm not down 15% upon buying it. Like most people are pretty simple. I mean, and if you have really, really tight risk management, you can be simple, right? I mean, okay.
Yeah, I mean, you don't have to do these complicated things of running supply and demand plus the WMA 30 and then throwing fib levels on there.
Right.
And
That's
playing a
another
rejection
thing I
of
was
the
hoping we could touch on. Right.
37.5% and hoping for the move back down to 50. If it, makes a doji candle on the 50 fib level, you buy call. Like, you don't have to do that. It's
So if they're not going to use all these quote unquote tools that other people have given them, where do they start? Like,
I mean,
how do they know?
I mean,
if that's what they want to do.
You almost have to play. That's why the simulator is great.
Right.
Play around, figure it out. But if someone is out there saying you need this indicator on, you need, you need to draw, rectangles, you need to have 3 different moving averages on, you need to then run a fib level from the close of this candle down to the bottom of this candle when there's 2 dojis at the top and the bottom, and then play the bounce. You don't got to do all of that. That is so stupid. And for those of you traders who do that and teach that to people, shame on you. Seriously, it's horrible. It's horrible teaching.
Well, I wouldn't even say, to be honest, I'm going to be honest with you. I don't even think it's shame on them. I think this is what they know, and this is what they say works for them, which I don't think everybody's honest about their losses.
No, definitely not.
I mean, I know that I will say, I follow a lot of different personalities. I talk to them all the time. And there are certain people that I give a lot more credence and reputation to because they're honest about their P&L, and they'll straight up post it. Be like, dude, I took a huge loss today. I fucked up. And that's so respect. I respect the hell out of that. Like, I really do, because most of them don't. Hell, even I've gotten to the point where I'll say, well, why do I need to post it? Like, if I posted what trade I was looking at and it didn't go my way, you should just assume it was 20%.
Yeah.
But the hard part though is, like, if you're an influencer, or if you're somebody that's charging people for alerts, like, man, you bitch, you better fucking post that shit, because I've seen a lot of rooms where people will start to get heated and mad. Like, dude, we followed you into that trade and you lost us money, and you didn't tell us when you got out. Well, first and foremost, it's not their fucking responsibility to tell you when you get out.
Absolutely not.
It's your money.
Yeah. So
it's your money. I don't want to hear any bitching. You follow this dude to a trade, you better own your shit.
Yeah.
If
there's kind of one little piece of advice I could give people about following Discord alerts. They are not buy and sell entries. They are a watch list. They are a live market watch list. Quit treating them as some, as soon as someone posts something, don't just go out and buy it. You aren't going to see the same things they see. It's not going to happen.
Exactly. Chances are they already have a plan.
Yeah.
They're telling you what they're doing, but they're not telling you the entire process.
No, that would take way too long to type out. So you going in Discords, whether it's free, whether it's paid, whatever, I don't care. Looking at the trades that they're making, going back, figuring out why they're making them and what they're seeing is going to pay you so many more dividends than sitting here trying to blindly follow.
I love that.
Blindly follow, you can make money. Don't get me wrong. I've seen plenty of people do it, and I know people who do it and make a lot of money every day. But what happens when your favorite trader decides, hey guys, I'm shutting down this Discord, or I I'm getting married and or I just had a kid and I'm no longer, going to be doing this all the time anymore. What do you do then? Go find another guy? No, be reasonable. You're getting older with them. You are
Time to
going,
learn.
yeah, you're getting older just like they're getting older. You're gonna have, you're gonna want to go out with friends, have a girlfriend, get married, have kids, all these other things. So,
Mhm.
you by just following trades, you almost limit yourself to this 3 to 5 year, it's, yeah, I don't know yet because, we haven't seen this evolve yet, but, like
Right.
this 3 to 5 year time period of, oh my God, I have to make all this money really quick. I never know when this guy is going to leave or whatever.
We are definitely in the beginning phases of the FinTwit personality.
Yeah.
I mean,
But
within the last 3 years, you know.
so let's just say, at the average age of all these people on FinTech, let's just say we're all in the average age of, like 22. Okay. 5 years from now, we're 27. I highly doubt I'm still gonna be all in Discords and everything, all
Right.
and doing all this stuff. I'm gonna want to go be out with friends and have a get a girlfriend, get married, have a kid, all these other things.
Mhm.
So what happens when I go away and you're following my trades? You're gonna
Good,
be
that's a good point.
in a very, very bad position.
So,
So
and that's why
really,
I really respect the people that are more that focus more on education. Like, let's teach you trading mentality. Let's teach you like actual worth of fuck strategies that are consistent, that will allow you to develop your mindset around trading. I just started this new class. I have 12 students,
nice,
and
congratulations.
like, oh, thank you. That's kind of where the roundtable thing started. Like
Right?
I literally just posted and was like, hey, can I get one guy to come on our call? I'm teaching these guys the basics, and I would just love to hear them hear a realistic point of view.
Yeah.
Somebody that's been doing it longer than I have, because I can teach them trading. I can teach them how to look at macro level news. I can teach them how to look at different stuff.
Yep.
Obviously I have a different level of experience than a lot of the options guys on the internet.
And that's fine.
Like
Everyone has to start somewhere.
my mentality is totally different. Like I'm sitting here looking at news on a much larger scale than what a lot of other people will say. A lot of people are playing news plays. 30 seconds that premium's going to run jack for about 10 seconds, and then you're left holding the bag if you don't get out.
Yeah.
Like there's a lot of that.
And then
Um,
and then we'll
and it's
we'll add,
exhilarating, and it
yeah.
reminds you of being at the casino, looking at the craps table.
Yeah, and I mean, if you even want to kind of dig and add another layer onto that, whenever you have a move happen like that, you have to think of what just happened to the bid-ask spread in that time period, and how much slippage are you going to incur between your order and the next guy's order. And that can be another conversation that we get into, at another time. But
I'm kind of just free flowing this, by the way. Like I have no clue what we're going to talk about.
nope.
I'm just
I mean,
really, really
I had a
grateful
script,
to
and
to
I had
hear.
I had a
Like
script, and we've done exactly what we said we weren't gonna do, but we're doing it.
I'm okay with it though, man, because these are the kind of conversations that need to be had.
Yeah,
Like before you can even dig in, before you can even begin to look at this stuff from a realistic perspective, there's a lot of things that you have to preface. Like the whole. I guess what I like to say is, if it's too good to be true, it probably is.
yeah.
There's not a single trader on this earth that's doubling their portfolio 270 days a year.
They'd own North
Like,
America.
shut the fuck up.
Yeah,
Like,
they'd own North America. And whenever
there's
they
a guy out there that says, I'm going to take $10 to $1 million in 3 months. Okay, dude, you do that.
and and let's I want to kind of set the record straight on that one. What they're saying when they're doing that is they are doubling the amount of money that they put into the trade. They're not actually doubling their account. they are doubling a $500 options lotto contract that they took, and they're doubling that 500 into 1,000.
Well, I
And
mean, but
and you
what do
can
you do?
do
What do you
that.
do when you see people on Twitter saying, "Look at my last 1 month P&L. I'm up 4,000 fucking percent or whatever."
Do they show the dollar
Like,
amount?
well, most likely not. But
Exactly.
if they do, even let's just say everything holds true.
Yeah.
Do you know what they're fucking risking?
They're
Like,
full porting every
they're
time.
full porting every single day.
Yeah.
Like, it's crazy.
And if
That's not realistic for the person that wants to make this in the long
no,
run.
not at all. But I mean, if you're
Yeah.
making 150 grand at your, your normal job, and you have an extra $500 or whatever just to lotto everything into options contracts for 2 to 4 weeks, sure, go ahead. But don't then come back on Twitter saying, oh, you can do this too. No, you can't. I promise you, you cannot.
Right.
Not gonna happen.
Hey, just take my alerts and you can do what I do.
Right.
You know what I mean?
But
I
no,
don't know.
from the education
Like,
standpoint, I think you and I and a couple other people are really starting to get out there and work on changing things. And I know I personally have actually caught a little bit of flack recently for some of the things that I've said in on Twitter and my Twitter DMs, um, for exposing people, so to speak. And they've lost, some of these bigger guys have lost some followers because of some of the things that have been said from either myself or some other people that I know. And it's like we're not trying to necessarily call you out, but if we're going to provide this education and information and people connect the dots on their own, it's not our fault. It's your fault, and you're the one who's doing this. Why? And of course, they have to blame someone else because no one in this world anymore is ever wrong and can own up to their own shit. But
well,
it's
I
like
think because of this space being so new, I think eventually the chickens always come home to roost.
yep.
And your old posts you'll be fucked with it.
Even if you
And
delete them,
even if you delete them, somebody
still
will have a
gone.
screenshot of something you said or an alert you gave, and
You
it's
can
like,
there's a
you know,
website. It's called Wayback Machine.
right,
I can pull anyone's tweets for their entire history,
right.
and it's just sitting there.
And see, like, I think this was a much better conversation to have one on one, because when we do these big roundtable talks, like, I absolutely love them, because the whole goal with that is, basically just to expose people to a variety of information. I vet all the people I bring onto the calls. Um, Now, there are some people that have recently started changing their styles. And when I originally knew them, they had a whole different style. And I'm like, okay, well, this is obviously relatively new to you. And there's no way you can claim to be an expert of it when you've only been doing it for a few months. Like,
Right.
I thought you were going to talk about something else. And that's okay. The more information, the better. If it's quality, if it's high quality information, right?
But don't act like an expert.
Well, yeah, just don't be an expert whenever you're.
Yeah.
And I'll be the first one to humble myself and say, hey, I don't know shit about this or that. I'm going to ask some stupid questions, because I'm that guy that sits in the front row of the classroom that constantly stopping the professor and saying, hey, wait, can you just, before we move on, can you just clarify this for me?
Yeah.
Like,
I mean,
I am that totally that
yeah. I mean,
guy. Like,
over in our server, I get, people, or even over in some of the other servers I'm in, people say, I'm smart and all these other things. I'm like, I really don't know shit. I just,
right?
I just don't. At least to me, it doesn't seem like I do. Even though I might to other people, it's like I'm not the smartest guy in the room. I am
Well,
still
and if
here
you
to
are, you're in
just,
the wrong room.
yeah, I'm still here to learn to learn from people
I
and
love that, man.
still educate other people. But if I don't know something, I'm not going to sit here and pretend like I know it. I'm going to go find the answer to it, but I don't know it.
Well, I'm really excited for, I mean, me and you can sit here and gab all
Oh,
night
we still have a
long.
lot more to get into.
Like, let's go. I am Well, I'm absolutely loving this because this is the kind of reality that people need to be exposed to, you know?
Yeah.
Like,
So
this is what I want to be. I want to be a beacon for truth. I want to be a beacon for quality information. I want to be a beacon for a pragmatic, realistic way of looking at the markets. Um,
yeah.
I don't want to be this high intensity, emotional, like person, like, because that's not the way I trade. I mean, if people ever listen to my live trading, every once in a while, I'll be like, hey, yo, this is running right now. Like, this is breaking out of a channel right now. I'll say it, but chances of me taking that trade, I'll probably scalp it. Like, I'm literally just in and out real quick, making a quick play. I don't want people to be disillusioned and thinking, oh, I'm throwing in my fucking stack on this. Because what happens whenever that even pauses for a little bit? It goes sideways. Boom, you're already down 20%.
Yep.
So I'm really happy that we've gotten to have these
Yeah.
more,
And I
a
mean,
more
education
realistic conversation.
and education is huge. I mean, I know we're gonna get flack for it, but we are building a trading course, and it's in progress. I was supposed to have it done like 2 months ago, but I'm not gonna put out shit content. So,
Right.
it's something we're working on. I know I'm gonna catch flack for it because I've shit on courses all the time, but now I'm finally building one. Whatever. Even
Well, it
even
sounds to
over.
me like the information you're going to put on there though is going to be a lot more, you know, high quality, right?
Yeah, I
Right.
mean, we're at like 200, 250 pages and like
Oh
halfway
wow,
done. So I mean, it's gonna be pretty thick.
I like
But
it.
even if
Juicy.
even if we want to take this bigger on the hedge fund side, we are currently creating videos and educational things on, and we're gonna post them on our website. And it's gonna be like a free little like mini course that people can hop on. They can understand in a quick 30 to 60 minutes, through a course of several videos, what exactly a baseline understanding version of what it is our trade strategy is, what it does, how it works, why it's so efficient. And from there, from a business model perspective, that then is going to inherently train our people, that our LPs are going to want to invest with us, that they understand what we're doing. So we don't have to sit here for hours on hours on the calls and explain to them what we're doing. Anytime you can educate people, it's going to pay. It's going to do so good, so much good for you. So reason I say that is this isn't education isn't just something that is being done here on the Twitter space, and that we feel like needs to be done just for you guys. Even from a big business standpoint, a hedge fund, we're educating people on what we're doing. We're transparent about everything. We're launching a 60-day trading challenge over on the fund right now for people to live trade with us every single day to learn our strategy. Like, if the more you educate and the more you learn things, the more people are going to want to be around you, or come to you for questions. And the easier it is just to have conversations and grow and develop all together for everyone involved. Not only the people being educated, but the educators themselves.
Love it.
Alrighty.
What's
So
next on your list, man? Like,
yeah,
let's just keep
so
rolling. That
yeah.
was awesome.
Do we want to kind of break down the Fed meeting that just happened?
Yeah, absolutely.
All right.
I definitely think that's a conversation we're having for sure.
Yeah, 'cause I know I know there's a lot that's happened, and it's been crazy, and unfortunately people don't know how to read that stuff. So let's kind of get into it a little bit. So I don't know if you watched it or how many of people that are listening had watched this, but um Powell tried to play bad cop, good cop in his meeting. Um, he basically inverted the roles of what it traditionally is of good cop, bad cop, but that was still his idea. Uh, he went out in the first part of his conference and the summary of economic projections. He was pretty hawkish, or at least he met the very hawkish market expectations. And we need to measure what the Fed delivers against what the market is pricing in across asset classes. I'm going to stop here just for a quick second. This is probably going to go over a lot of people's heads, and Alan, take notes, ask questions along the way, because it's going to get pretty deep. Um, so need to measure what the Fed it delivers against the market versus what the market is pricing in across asset classes, being bonds, credit spreads, equities, etc. And he met those expectations, I think, because what he did there in the meeting is effectively in the press release, he took off a sentence where he said that earlier in the earlier meeting, he said that they are going to hike rates, but the labor market will remain strong. That sentence was erased by the actual press release. It was changed into a statement that said something along the lines of, we are very committed to hiking interest rates to make sure inflation goes down to 2%. So there was no mention anymore of a strong labor market, and that was reflected pretty well in the summary of economic projections. I think I have that actual picture. Yeah, I do have that picture. Awesome. Let me go ahead and share that.
Yeah, help yourself.
Yeah, there we go. You see that okay on there?
Looks good.
Pretty big, but just
The numbers are just a little blurry, but we can read it.
yeah, you can if you squint, you can see them.
yeah, we're good.
So we'll look at, we'll look at these guys. What they did was already pretty telling. We have an unemployment rate that in their projections moves up from 3.7% all the way above 4% by 2024. So they are aware at this point that they will do some collateral damage to the economy as they progress in raising rates to lower inflation. They now acknowledge that. Nevertheless, the Fed funds rate is projected to go all the way up to 3.8% in 2023. And this number shouldn't be looked at in an absolute basis of exactly what's going to happen, but rather a relative term versus the longer run Fed funds rate, which is another way to say the neutral rate at 2.5%. I know people get pretty confused about what a neutral rate means because there's no definition. It is just the longer run Fed funds rate. So they have a neutral rate of 2.5%, and they want to hike 130 basis points above neutral, and they want to keep rates above neutral also in 2024. Also, an unemployment rate is rising, also when the economy is slowing down. So they're so committed in their own summary of economic projections that collateral damage is the problem, but they're going to remain tight anyways. Another thing, kind of is interesting here is core inflation projections. Conditional to their very tight stance of a very long time, conditional to the collateral damage they'll be doing to the labor market, even though core PC inflation slows to only 2.7% in 2023 and then 2.3% in 2024, those are levels still way above their inflation target. I know it doesn't seem like a lot, but 30 basis points or 70 basis points is still pretty large whenever you're talking in terms of inflation or bonds. Basically in a nutshell, what they're telling you at the press statement they released in the summary is we know we have to be serious and we will be serious. We're going to cause collateral damage to the economy. And even then, we are unsure that we can meet our inflation target. So take us very seriously because we want to get there and we are going to get there. Even if he didn't say it so directly, the implication was clear. He had said, obviously, we never think that too many people had a job. However, we need the labor market. We need to have the labor market in line with our financial conditions for inflation, etc. He was essentially saying that as much as that, and in March they had said that they expect inflation to return to 2% and the labor market to remain strong, and that has now been replaced by the FOMC saying that it's strongly committed to returning back to its 2% objective, but no mention of a persistently strong labor market anymore.
I have no doubt that 2% is unrealistic at this point, but that's just me.
Yeah, it's insane projection at this point. The Fed the Fed is an optimist at best. I don't know if I can find a time when the Fed was able to actually meet what they say. especially not now. I mean, they've let this shit storm go on for so long. But I want to kind of set the stage for you guys who haven't, been following this as closely. So the 75 basis point hike that we got last week was a shock to what folks in the market had been expecting. But the Fed, what the Fed sent out like forward guidance of sorts, and they like to kind of give the market a heads up to what they're going to announce. So, we originally it was 50 basis points, but then it came in at that. I think it was Monday night or Tuesday morning. There was a leak through Steve Leesman over at CNBC saying that the Fed is considering doing a 75 basis point rate hike. So before the press release and Powell went on, the market was already pricing in a 95% percent chance and probability of a 75 basis point hike, with the risk then being a 100 basis point hike opposed to 50 basis points. So the 75 basis point wasn't a shock to the market on Wednesday. Rather, though, Monday and Tuesday, after a huge disaster of a CPI release, I think we came in at 8.3%. Like the projection was down in the sevens or something. I mean, it was bad. So the reason that the market rallied, even though it has since crashed back after the Fed, we had a pretty substantial rally starting around 2 o'clock Eastern Standard Time when the statement was released, and that continued into 2:30 after Powell was speaking, and it exploded higher around 3:30, and then a little bit of a fallback, and it eventually turned quite negative back down. Going into Thursday in that overnight session. Charting was charting things out whenever you're looking at macro forces is going to help give you a lot of great clarity, and I think they're pretty important. The R square is.
So let me ask you this real quick before we
Yep.
dive into that too much. When you see the Fed funds rate going up, you see inflation going up. What is let me rephrase this. What is your first trigger as far as sectors when you see those particular indicators going up? What do you see as an inverse correlation to that, and what do you see as a positive correlation to that from a macro level perspective? What do you see struggling? What do you see succeeding in the grand scheme of things whenever prices are going up, that kind of thing?
I'm gonna dive into that more bit later as far as some deeper things, but from a macro perspective, whenever you have inflation going on and you have rising rates, and we're going to tie in the energy sector a bit, you have all of these things surging on and raging, and there's no real there's no safe place for your money. There's really not. As rates increase, understanding how bonds work and how debt works and the service to maintain debt works. We all knew that rates were going to start going up. So back, in January, even March timeframe, after that first rate hike really hit, you could have started to look, at tech and shorting tech. We all knew that tech was going to fall once they started raising rates. Tech relies heavily on debt and debt leveraging. That's going to impact their debt service agreements that they have. Big institutional buyers do a lot of trading on overnight repos from big banks, where they'll take cash from the bank and trade overnight and whatnot, and then they'll give it back the next day. So all of these certain little factors, it may not seem like a lot going from 0.25 to 1, but that is a lot higher interest payment if you really run the numbers on that whenever you're borrowing overnight $1 billion. Or you have to basically gain an extra 0.75%, so to speak, just to be able to make the same trade and remain profitable. So it's a lot. It's a lot of shock going into that.
And to add to the shock value, I mean, I think the max is like 80 billion or something per counterparty now. Didn't they? I think they upped the maximum last year at some point for borrowing overnight, right?
Yeah, I think you're right in that, but I would put a lot of money on it that people are borrowing a lot more than that.
I believe that.
There's a lot of things that you can do to kind of, you know, cook the books and whatnot.
Fair enough.
Yeah. So the R squared, you know, it's very high between if short-term interest rates go up or they go down, where the 2-year goes, the S&P tends to go, at least on FOMC day. Let me switch charts here. Oops. Do I want this one? No. Sorry, bear with me for a second. There we go. Okay, so we have the 2-year inflation swap in blue and the 2-year treasury yield in orange there. And gonna kind of explain what exactly is happening. So that's when Powell played good cop in the beginning parts of that meeting there. There's a bit more on the bad cop side overall, and it prevailed in the narrative. And I think the relief rally, of course, can last. It couldn't last, you know, so to speak, and then, you know, we can kind of explain why. The good cop play that released the relief rally basically started when he had said that 75 basis points are not expected to be common practice going forward. And then he said something very nuanced that people should really pay attention to moving forward. He basically said that we're going to be around neutral by late summer. And then once we get there, we might want to do more hikes to go above neutral, but perhaps we're going to choose a pace of hikes that is less aggressive than 75 basis points. So he was hinting that once you go to 2.5%, they are going to then prefer a 25 basis point hiking path, all to go all the way up to 3.8%, than the bigger steps of just leaping 0.75, you know, the whole way up and through. And that's quite a surprise because the bond market isn't a black or white market. It's not a binary outcome machine. The bond market is it's a consensus weighted probabilistic machine. It looks at different probabilities, it weighs them in, and then you see one bond yield come across the screen. But that bond yield is a result of different outcomes with different probabilities being priced in. And what Powell told people right in that moment was that the first of all 75 basis points in July, and you're going to doubt that it was 100% priced in at that point. The first leg, it needs to be repriced down. It means bond yields can rally because there's less to be priced in, that it was already discounted back then. Now going forward, once you reach 2.5%, you need to take more time to reach the terminal rate. It's a bit of a shallower path up, which also means that you have to reprice that back in front in bond yields. So the orange line on the right-hand side there, you can see a huge drop from 3.43% to 3.2%. It's a 20, almost 25 basis points rally in a few hours, which is huge. That's a very large move in the bond market. I don't remember the standard deviation move in comparison, you know, and other historical 2-hour rolling moves, but I'd say it's like a 10 standard deviation move or so. So I mean, it's a very, very large move. The interesting thing that is the blue line on the left side, that's inflation swaps. That's the market pricing for, let's call it inflation over the next 2 years. You can see the exact moment that the bond market called, that the inflation swap market, trying to think of how to say this in a dumbed down way. Basically, at the exact moment the bond market was notified and it called that the inflation swap market, the inflation swap market repriced itself up higher inflation over the next 5 years. That's sorry, that's the simplest way I can say that. And the question becomes why did that happen? Well, because Powell just committed to being less aggressive, and he committed to take more time and a more gradualistic time in term of array to reach the goals. Now, when that happens, nominal yields go back down very quickly. Inflation swaps go up. Real yields, as a result, drop, and they drop very, very aggressively. And when real yields drop that fast, all the asset classes that are related and have cash flows to be discounted to real yields, equities, for example, equities start to rally. And then you have that situation where you see the S&P, let me switch screens here. There we go. All right. So then you have the blue line, which is the SPX on the left, and then US terminal rate on in orange there. So the S&P staged a rally that was a mechanical rally as real interest rates had been pushed down by the reporting in the bond market, and inflation swaps were going up. That underpins a rally in the S&P. But now why I think this really doesn't have legs, and I can use, we can use the past by now as to what happened, is that you can try and believe, Powell, that they're going to be more gradual in reaching the terminal rate at 3.8%, but you can't reasonably price as a bond trader that the Fed is not going to get to 3.8%. They can take a little longer and it can be a bit shallower, but there's sort of a floor, which is this red line here, that is the US terminal rate. And it shows us the market pricing for the highest peak and the hype in the cycle, looking at euro dollar futures. We don't need to get into that. That was above 4% before the Fed spoke, and then Powell came in and said, it's actually 3.8. We'll take some more time to get down there. Big rally, terminal rate gets replaced. Well, it has to get repriced somewhere. All the way down to 3.8% whenever he says that. Can take longer. So you move a bit down, the curve, etc., all these other things that you can do to it to figure it out. But 3.8%, that's it. It doesn't matter how long it takes there. You can do whatever you want to figure it out, but our bottom line is 3.8. So if that is the main reason why the stock market is rallying, you basically have a floor there, and it's a credibility floor for the Fed, because they're telling us that they're going to get to 3.8, but as a bond trader, you then have to price in risk premium that they have to do more than 3.8. Unless inflation is slowing down, what the Fed tells you is seriously just best case scenario. And like I said earlier, the Fed is never right. They suck. That is horrible. But for the last few months, the bond market has kind of been guiding the Fed towards what is the level that they deem acceptable. So in this case, inflation momentum hasn't slowed down. There's no reason for which the bond market would credibly attach a negative risk premium to the Fed not reaching the terminal rate. It should be 3.8 and then something on top. So as soon as the market realized the bond market had rallied too much, and so the fuel for this relief rally and other asset classes was over, and in the matter of a few hours overnight and into the following day, we sold back everything, because ultimately it just cannot work. And that's another reason why I think risk assets, such that of a lot of things that we trade in the NASDAQ, are going to have a hard time picking up a relief rally. At least a sustainable one is due to, volatility and implied volatility in the bond market. I know I need to do a bit of explaining here, but and I think it's important for people to understand what we'll go ahead and give a little bit of background as to what I'm talking about. I know that was a lot, but bear with me and just stick along for the ride.
I think you're doing great, man. This is
yeah.
great.
The treasury market is the building foundation. It's the building block of all risk-taking activities across the board, leveraged and unleveraged. So if you're a private investor, let's say an unleveraged person, your opportunity cost, the first one you choose always is to have your money in a bank account or to buy treasuries. Those are your first options you have. And a bank account is a liability of a commercial bank. It's guaranteed up to $100,000. Anything above that, and you're running banking credit risk. JP Morgan in default, Wells Fargo's in default. You lose all your money, no guarantee. Now you can always get out of that by moving that form of money into another form of money, and that's the treasury bond. Now the treasury bond is a liability of the government, and it's safer from a credit default perspective above $100,000, and the reliability of a commercial bank, and it generally is a money-like instrument within that. It's very liquid and it's very tradable. Generally, bonds aren't that volatile, and it yields better than a bank deposit. It's kind of a no-brainer. If you are leveraged or a leveraged investor, it's a similar thing because the bond market is the most liquid market in the world. It's the biggest and deepest repo market, and you can just lever the shit out of yourself in it. If the volatility in the very, very base market for us unleveraged investors and for the leveraged investor starts to be extremely volatile, you can start to understand that the amount of risk you take in that market is lower because people are bound in. And let's say, traders, risk takers, market makers, they're all bound by this volatility. Their P&L goes up and down, and their volatility models or so-called value at risk models, for example, that you can do for all these cool little things that people like to show off. And so if the volatility increases, then the positions they can take in the same assets are lowered because for the same position, the volatility will otherwise be bigger. They are forced to reduce their position in bonds. Let me see. I have this other one. Do not, unfortunately. But I chartalized, the annualized implied volatility and 5-year US bonds, and wish I had it so I could pull it up. But if I could, you would see immediately that there's such a level of uncertainty in the implied volatility being priced into the bond market. It's very large. It's 130, 140 basis points annualized volatility for the year. And this is the same uncertainty levels that we saw during the great financial crisis. And when there is that much volatility, people can't take risk in the bond market. Imagine if they can take risk in the credit market, high yield market, equities market, and it all starts from the foundation. If the foundation is shaky and the foundation is volatile, you can't take risk easily. You don't have the risk budget to do so. And so Powell didn't do anything at all to clear the volatility in there, but actually gave us more to price in due to the good cop, bad cop. And on top of that, there's sort of a bottom the bond market can price in terms of how a commodity on a marginal basis the Fed can be. So this risk rally that we're seeing, and it just can't work. I know that's a lot to unpack, but the terminal rate is the highest point the market thinks the Fed can reach. It reached a peak of 4.05% on Friday or Monday, a couple weeks back, and it decreased and decreased. It can't really go below 3.8 because it is the medium implication that we got in the summary of economic projections. In 2023, the median projections is 3.8 for the Fed funds rate, and if you look at the range, the lowest projection is 3.1%. Back in March, it's got to be March. Back in March, James Bullard was the outlier in all of this, saying that we should go to 3% right now, but now no one on the FOMC is projecting that we go even below 3% now. So the bond market to price in a terminal rate below 3.8% is really taking a gamble that the Fed can hike or can't hike, and that gamble has not been paying off. Also want to note that I use mechanically a lot, and it's important because if we take a look back at that 2-year Treasury and 2-year inflation swap curve, I guess let's pull it back up. Do it this way. Nope, am I showing the right one here?
Yes.
You see,
Well, you're showing the blue and orange.
2-year, does it say 2-year Treasuries and 2-year inflation swaps at the top?
Yes. Yeah.
Okay, perfect. Where was I? Oh yeah. So if we go back to the 2-year Treasury and the 2-year inflation swap curve, there's a lot of people who doubt the Federal Reserve's ability to control interest rates. And they think that the bond market is leading the Fed. But, I think up until this point that the Fed is kind of pulling the strings on the bond market now. The control of the Fed over the bond market has kind of been complete, and it's almost seems like it's a balance now at this point, truthfully. And when the Fed really likes where the bond market is going at this point, it just am very, very doubtful of the Fed's ability to control inflation itself, not the 2-year Treasury or the financial system or any of that, but the actual economy and inflation itself. People going to stores, people buying stuff, going on vacation, so on and so forth. And in fact, if you wanted to invert these lines, as soon as you invert this blue line and the 2-year goes down and the swaps go up, if you were to flip, they would basically fall on each other. And the macroeconomic interpretation of this is the lower Treasury yields are, the higher inflation will be, and the higher the yields are, the lower inflation should be. But it really just isn't that simple. And so this is pretty much has to be, some algorithm that is using a model that makes the assumption that when yields go down, swaps go up, or all these other things, and just not true. That's not how it works. There's so many things that play into that. But in this case, though, we are in a phase of a cycle where marginally higher interest rates are designed and are a wish of the central bank to make sure that you and I and the listeners can't access credit in an easy way, and they have to find credit to be pretty expensive, thus less attractive. If 2-year Treasury yields are going higher, let's say 5-year, 10-year, kind of help people understand. Let's say 5 and 10-year yields, and you are in an economy that is slowing down as well in the economic growth impulse. You as a private citizen need to pay a credit spread on top of Treasury yields to borrow, no matter the form, whether it's a car loan, mortgage, whatever you're borrowing from, there is a credit spread on top. And why is because you're not the Treasury. You can default. You can lose your job, so on and so forth. So the banks or other lenders apply a credit spread on top. If the base layer Treasury yields are rising and your credit spreads are also widening a bit because the economy is slowing down, right? That's what we see happening. So there's a higher probability that, especially now with the economic projections that are being made, that you might lose your job. So it needs to be reflected in credit spreads. Your all-in loan yield, your borrowing yield as a corporate company, as a private citizen, house buyer, it's going to go up. And when it goes up, you'll be looking at the same loan you were looking at 2 years ago, for example, and you'll be saying to yourself, oh crap, I can't afford it anymore because my monthly installment is too high compared to my disposable income or salary, whatever it may be. And when that happens to a point that it becomes quite tight, you'll be paring back your spending. You'll be paring back your second home buying, your first home buying, you're paring back your business because maybe you can refinance your business. You may have to shrink it a bit, but you can do it. If it's too expensive to refinance and say your business model doesn't work, your only opportunity really is to shrink it. So you're going to then be firing some guys or cutting back some expensive. Is exactly what the Federal Reserve wants to make sure happens so that aggregate demand in the marketplace slows to the appropriate, an appropriate point, that enough damage is done basically to bring down inflation as well. Um, so exactly what the Federal Reserve happens to be doing. So this is why in this part of the cycle, if Treasury yields rally, especially as a result of the Federal Reserve showing a bit less commitment than it priced in, then inflation swaps go in or go up because it means the Fed isn't doing enough of a credible job to transfer higher borrowing costs to us as everyday consumers. So we're then going to be discouraged to take on, or sorry, if that happens, we're going to be less discouraged actually to take on credit, which means it's going to continue to fuel the inflation fire. At this point in the cycle, the macro explanation works in a way, generally speaking, there's some mechanical adjustments, especially during the conference where algos are trading and it's a lot of fast money, but the overlying macro principle is still pretty true. Um, but there's definitely a solid macro explanation for which, especially when the central bank credibility is tainted, when Powell says we're going to go to a terminal 3.8, but we're going to go slower, cautious, 75 basis points now, slow it down a little bit later. That 75 isn't the new normal. He sounds a bit less committed than priced in, and that's enough for the bond market to rally, enough for the inflation swap to rally, to reprice a higher probability of higher inflation. Central bank needs to be extremely careful here, and its whole good cop, bad cop strategy doesn't really help or do us any favors, in my opinion. All it is effectively done at this point is increased implied volatility. It makes all the moves that we see sharper. It dents the credibility of the central banks. What they need to do, truthfully, is the exact opposite. I'm not saying what they need to do is going to be easy. There's going to be my solution for what we need to do. There would be a lot of collateral damage and a lot larger numbers than what the Fed is putting in their summary of economic projection. But
Do you believe that this has anything to do with it being an election year?
yes and no.
Why they're slow walking a lot of this stuff?
I wish I
mean,
do.
it's a loaded question, but
Yeah, I mean, I wish I knew. Unfortunately, I don't. But if man, that kind of makes it political. I don't know if I want.
yeah, we don't have to go down that road. But I mean, I think that's what a lot of people
There's definitely a lot
suspect.
at play. There's you have to think. Powell was appointed by our president, so I'm sure they're talking to each other on a basis. And as a chairman of the Fed, I mean, you have the president talking to you. I'm sure you're talking to people over on different in the Congress, being the House and the Senate and some of their different boards and committees they have within there. You're talking to big banks. You're talking to different hedge funds, you're talking to institutional trading firms, you're talking to, JP Morgan, um, Wells Fargo, all these other places, and you're trying to kind of figure out how you can, do this, but still kind of make everyone happy, to make sure that everyone stays on the board or gets reelected and all these other things. Because, at the end of the day, nobody, well, us as traders and us as investors, we know that there's a lot of things that happen that are derived from what the Fed does. But then again, the Fed, the Fed is already not really looked at by a lot of traders, except until they hear about it and they say they need to listen to it. But no, most people don't even know what they're saying in there, and they don't watch it. So
Yes.
understanding, and it's understand how like the politics of it work is your average person isn't going to, if they say they see something bad about one of the House representatives running this fall, and they're like, oh, this person did X, X, and X. Well, it may not be direct correlation of something that they did. It may have been something that the Fed did or the president did or that someone did in another country, all the other things, but it's going to come back and get pinned on them. So I don't think that any of this necessarily has to do with an economic or with a political thing based on the economy. If this is an attempt to try and get people reelected, this is the worst attempt I have ever seen at anything. And it's not just Biden's fault. It's not just Trump's fault. Everyone is to blame here. This stuff backdates all the way. Really, I mean, it backdates to Obama, but you could even make an argument that it dates back to Bush in the 2000s. It's not just one president. It's not just Democrat, Republican. It's a conglomerate of shit. And as the years went on, doesn't matter what party you're affiliated with, everyone added to the fire. What had happened though is when COVID hit and we decided to inject money into consumers' hands, it's like they didn't know what was going to happen.
They did though. I mean, like any economist worth their salt can tell you what's going to happen when you do that.
Yeah,
I'm
sorry,
not trying to talk shit. But
no, I know. I mean, they know what they
this
what they were
is
doing.
Econ 101 here.
Yeah, I mean, they knew what they were doing. They know what was going to happen. They know all of this stuff. They're not. Well, I can't say they're not stupid because that's actually incorrect. But, they knew what they were doing. They knew some of the outcomes of this. Do I necessarily think that people thought it was going to be this bad? No. Reason I think people didn't think it was going to be this bad is because they didn't really take into account what that money was going to do and how badly it was going to affect everything, and then taking into realization of what else has gone on since the housing crisis, when the Fed really started to print money and inject money and go in and buy mortgage-backed securities and all these other things. So it's kind of why I say the bad cop, good cop, and the half-hearted measures that the Fed's sending out. This is not the time for it. There's no soft landing here. It's just not. There's nothing's good about what's about to happen. And I hate to be that guy, but whatever. You can discuss it with
I would
me
much
and hate me
rather
later.
have a realistic conversation.
Yeah, I'm not gonna sit here and sugarcoat it. Oh, we're gonna, market rally in 2 months. No, we're gonna be down for a while. It's gonna suck. It's gonna hurt. Whatever. I don't care. It is what it is. Not me hiding away from it in the closet isn't going to change what happens. So the mechanism about the guy who can't get credit from the business perspective, so he has to lay people off, etc., and do all these other things, so on and so forth. It's through the bank lending. and whatnot. And just to touch a bit more on that side of it, it would be it would be true though through the bond market and the bank lending sector effectively, and then a bit more complicated, but by through collateral refinancing. So if I was giving you a bond, Alan, and I had to refinance, and then the repo levels exploded, then that is also a more expensive exercise than before. But for simplicity purpose, let's just kind of make this from a borrowing perspective. So bonds, and so borrowing on the financial markets or lending from banks. So, you guys are investors or traders, at least many of you are participating in the market, whether it be actively trading or have a 401k, maybe, you're some bank manager, whatever. When the rates are higher, the Fed funds projected path is higher. And well, you've gone to college, so you'll get this. So what you'll learn in the macro 101 class in college was that when this happens, it sort of sucks in money. So instead of JP Morgan lending money to you, they lend it to the US government by buying treasuries. But then you go to macro 102 and you learn that banks can create money anyways, even though they're doing that. So, if you use your credit card, you just created money. So it's not really a problem with all of that. It's not that they don't have enough money. So, what's the mechanism by higher yields not letting you spend money at a restaurant per se? So yes, you can keep doing the whole credit card thing, and banks do it every time they lend. It's not an opportunity set where they either buy treasury bonds or they lend. It's not a one-to-one correlation. It's just not how it works. I hope most of you know that. If not, you're learning something very valuable, and I hope you can extrapolate on this. They don't use the same funds to buy treasuries or lend to other banks. They just create new money when they lend to people. But banks lend based on an incentive scheme trade-off effectively. I'll just kind of quickly describe that for you. A bank will be willing to lend if there is a willing borrower whose credit worthiness is solid. So it's true they make money, but they don't need to put capital against the money. Or sorry, they do need to put capital against the money that they just created. So yes, they can create it and they can make money, but they have to put capital against the money they just created. And that's the loan. And they don't want to lose the capital. So hey, Alan, you need to pay me back right now. So we need a willing borrower with good credit worthiness. Then we need a good reward for the risk we're taking, which means loan yield should be healthy enough for the bank to be paid for the risk it's taking. In this example, lending to Alan. So the third thing that kind of ties into this is regulation and balance sheet availability. So if the regulator is saying for every dollar you loan out, every dollar that I loan to Alan or the bank loans to Alan, I then have to attach $10 of capital to that on my balance sheet. Then from a return on equity perspective, and horrible business that he has going on, or he made $300,000 trading options and thought he could buy a Bugatti, but his strategy wasn't sustainable. If this regulation gets erased, it makes it more attractive to lend and vice versa. And it really depends from a lot of metrics that are, again, regulatory and balance sheet metrics. So right now we're in a situation where loan yields have gone up because treasuries have gone up and credit spreads have widened. So from that perspective, banks would make more money lending. Rates have gone up So let's just say, discounting, what we already know. Rates have gone up. We can agree on that. Let's just say they were at 3%, but they rose from 2% to 3% in a day. Okay, well, the spread on that's going to be wide because that's a lot of risk. And now I have to count in the risk of the bond going up to 4% next month. So I can have, I think, or I can have it at 3, but if I'm running the risk of it going to 4% in the next month or two, but Alan wants money, I need to now add something on top of that. So I need to give him this loan at 4.3%, opposed to say 3.5, because I'm taking on a lot of risk from this volatility and this jolt that we've seen happen. So now that the credit spreads have widened so far, it's going to take, the banks are now going to make more money lending, from that example. Now regulation hasn't material changed since last year and a half, I'd say. So from there, let's just assume, nothing has changed. Willing borrower, an eligible willing borrower and a good credit worthiness to borrow is what I'm not sure of what's going on in the market right now. Because again, a business model, or you're buying a house, etc., and being willing to get credit to buy a house and whatnot depends on the mortgage rates effectively. If it's good rates, there's more demand, vice versa. But on top of it, because the economy is slowing down, there's a higher chance of unemployment. Businesses are going to shrink as a result of that chance. So that credit worthiness angle is a bit sort of offset, and the trade-off structure that we kind of just, defined back there a few minutes ago, is nevertheless, if you look at bank lending over the last 6 months, as always, and if you go look at any crash that we've had late on in a cycle that we've gone through, bank lending has shot up a lot. And that's because loan yields are going up. And as always late in the cycle, it happens. And from many angles, it still seems that the economy is handling okay, sort of from a big economic position, not just the stock market, think bigger. So economic growth impulse is slowing down, but it's not super fast. We're not necessarily in a recession. You can make the argument that we are. I personally think we are, but we're also kind of not. We're right now slowing down to a below trend growth levels, but we're still sort of okay. We're not really in that recession period yet. And that is exactly the point where banks tend to lend more. Oh, sorry. I need to take a drink of water. I've been talking for a second. Give me 1 second.
That's all right. We should probably find some sort of way to wrap this particular part of the conversation up because I don't want to go too much longer. This is a conversation that can be had for days on end,
Yeah, I mean, we could go on for quite a while. We can.
Overall perspective for me in particular, and what I've kind of been seeing, especially with the negative GDP growth forecast. I think the main point that I like to try to get across, at least on a daily basis, is people can say that the rate hikes are priced in. Okay, this is what the market's expecting, right? But the effect of those rate hikes and the effect of these decisions, you can't plan for, at least not from
No, you
at least
can't.
not from a market perspective, right?
And we're not
we
going to
won't we
slow
won't know the
down.
effect of those until it happens.
Yeah, the problem with
Right.
monetary policy is that you have to you look at lagging data, and they're not going to switch their stance and change things. They're going to continue on the path that they're on until they see a consistent month-over-month basis of inflation slowing. Once we get a momentum shift, they can do that. The Fed has done so much and so much work at this point to try and control so many different things, but they only have partial control over these things, and they really, you can make an argument that they do it or don't, but the only thing they really have, partial control of in terms of is short-term interest rates, and they've done their job. The terminal rates, 3.8, 3.9. There's a lot of other factors that people don't consider into this, and this is the broader market side. There's credit spreads, equity valuations, and so much further.
Mhm.
We'll look to kind of wrap this up here. You know, I had been posting on Twitter. I know there was a couple other people who have done it, for a while now, and especially on conversations and discords, who have been saying pretty much exactly what we're seeing now and what was coming, how it was going to go, and have really been right up to this point. And what people can look to do essentially to hedge themselves or to be on the right side of things as we can continue on. You know, I manage money for a living. It's my job, and I know people who are trying to hold through this, and you're gonna get stopped out. You will be wrong. I'm going to be wrong. We're all gonna be wrong. But I try to give concrete ideas to people who will listen, both on a long term only portfolio, um, rather based retail investor, or someone who's more sophisticated and can take short positions, can do options, leverage, futures, etc. So a long only portfolio, I really haven't been able to come up with a good one that's suitable at this point to post and send out to people. It's something I'm looking at doing, and I will figure it out. But when you are in a deleveraging or close to deleveraging episode, where the amount of credit the real economy gets is less than before, the central banks are tightening on top of that. There's no place to hide. There's really not. And that's not bad per se. It's just a part of the cycle that we're going to go through, and we're already in. And in that part of the cycle, there's kind of three things that I'd say you want to do. You want to raise your cash allocation if you're a long only investor. If you are international and you're outside the US, I'd say you would want to get some dollar cash on top and get some exposure to the US dollar. And you want to have as little crap in your portfolio as possible. And what I mean by crap, I mean the high beta, valuation intensive, volatile, multiple layer driven stuff. Like things like Tesla. Just if if you're in at a good cost basis, just in hold, you can do whatever you want. I'm not holding any of that crap. Um, and you really don't want that, because the performance of of that entire asset class that has been stellar over 2020 and 2021, it's been stellar for a reason. And the exact same reason is fully reverting and inverting and doing the inverse of itself. So this is a moment where you should really be as far away from them as possible. And I'm sorry, because I'm sure people are going to ask me what I can do right now, and the answer is really nothing. You could maybe go into some commodities. I know there's been a lot of talk about gold, and I've seen people post, trades on GDX, but even from a commodity side of things, because of the supply and demand from a cyclical perspective, you have to be generally careful. Generally, you need to be careful. Generally speaking, you can buy dollar cash, and that will probably be the best thing for you to do. You can buy until things change, and when facts change, will change as well. Um, I'm not a perma bear, not a perma bull. I just try to look at the risk reward of different asset classes, and there are just cycles around you, and you need to respect them. Otherwise, you're going to get burned, and it's going to be very, very bad.
That includes the energy sector.
Yeah, even the energy sector is going to
right?
break.
I mean,
Yeah,
like it's cyclical. Every single year, the energy sector has ups and downs at relatively similar time periods. And what we're seeing now is, to me, you should have saw coming.
yeah.
Like,
The energy sector is in a very speculative bubble right now, and it has a lot to do with policy, not only U.S., for people who are going to ripe on me for talking shit about our president, as much as I'd love to. It's not all his fault, and I can't believe I'm saying that. It's not 100%
I
his
agree.
fault. It's, you have a lot of external forces. Are there things and policies that can be in place that could ease our suffering? Yeah, absolutely. But you have to consider we have OPEC to deal with, and we have the Russia-Ukraine situation to deal with. So while yes, things are directly correlated to policy, and there's different things that can be done to ease the pain and suffering, it's not 100% on him. I'd say
Right.
40%. So, um, you know, and then back to the kind of the portfolio side of what you can do. You can when it comes to more of a tactical portfolio, that's kind of a 1 to 3 month portfolio that uses shorts, leverage, options, and it's tactical in nature and it's designed to capture market opportunities when markets are going down or up, but in a low volatile regime, so to speak. So you want to look for more, kind of diversifiers there. You want to broaden yourself out. Um, I have shorted the S&P from an average, or average is around 440. Half of the position has been closed at this point. Also shorted some bonds over in Europe, and that position was actually closed 2 weeks ago, I want to say, last week or the week before. And the reason for that is that the Eurozone was under big pressure, and Italy was the big basically release valve in that. But the ECB said that they're going to fix it and do an anti-fragmentation, and that they're serious about it because once they clear that problem, they can hike rates seriously, and they don't want Italy to get in the way of that process. So, who am I to stand in the way of a central bank? A central bank has an infinite balance sheets, and I, unfortunately, as much as I'd like one, I don't have one of those.
That'd be nice.
Right? And
Right.
and because of a lot of those things, I don't think, and other things that I've said, in this recent segment, I know it's getting late and I've been rambling on.
Well, that's all right, man. This has been a great talk.
I don't think it's smart anymore to own that trade for those reasons. And like I said, I took profits on the S&P short, um, half of them at this point. I took some on a U.S. credit spread by an IDH portfolio. Just go Google it. I'm not explaining it. IDH portfolio. The short on the S&P, it's done really well, of course, and I can't be mad at that. And I'm just gonna keep updating my target for where I think it's gonna go as more information comes in. But back to risk reward that we were talking about earlier, I like to let my profits run and take the stop loss when necessary, and that's with the bonds as well that are being traded. And the reason I have these trades on is because financial conditions will have to tighten until we see progress on inflation. So I don't plan really on letting these trades go for a while. There's no level, or no outright level that the Fed will say that's enough. We can calm down. We really can only calm down if inflation is slowing down. So unless I see inflation momentum slowing, I'm not even necessarily looking for inflation to go, say we get inflation print at 8.5 one month. I'm not looking for it to be 8.3 the next. I'm looking for the momentum in that, however, to shift. But until then, I'm not going to change those positions. The unfortunate thing for most people is that, especially in a market like this, even if you're on the right side of the trade where you're long energy and short arc, for example, you can have vicious corrections within both of those. And we've seen it happen. We've seen oil go to 120, then back down to the low hundreds, back up towards 120, then back down now to where it's at 108. I mean, those are vicious moves within the oil industry, oil itself. And then the liquidity, not only in bonds but especially stocks, is very, very, very poor. From 3 p.m. to 3:30 Eastern, you had a vicious rally in SPY back on that day. And if you look in the market over any of these recent days we've had, and we have these moves, but then nothing is out there. I highly recommend people go out and learn about volume spread analysis, and you'll kind of understand what I'm saying as you learn about that. What I mean by this decreasing volume, and it's terrified and terrifying to be in anything right now. So yeah, I'm just gonna. Well, the only thing that I'm really looking as far as a new trade right now, outside of my book, it's the because everything's really short right now. Um, Looking at Japan in the BOJ, after the hike from the Swiss National Bank, it's pretty much the only developed market that's holding its ground, but I'm starting to see cracks appear in that. So I could
Oh,
see.
man, that's so funny you just said that. I just posted about that like less than a week ago, maybe.
Did you?
Yeah, that's
Yeah.
awesome. Yeah, that's great.
And then if you kind of look in that further, you can see some backdated Japanese bond futures starting to price and the probabilities that they'll have to start giving those away. So they're controlling their 10-year yields, but if you look at the derivatives markets that I trade, and I'm sure some of you guys listening have traded as well, you'll go and see these cracks starting to appear here and there. So I'm starting to think that if I go long, JPY, the actual currency itself, betting on the possibility that the BLJ will at least partially let go of the yield curve control, what is the point that the demand destruction becomes so visible that, there's a chance that it actually gets into the inflation prints and so on and so forth, and I'm able to make money on it. Kind of a complicated trade compared to what most people do here, but it's not. It's just another vehicle. Um, you know, we're already close to a recession or already in one, and you increase the probabilities that the Fed will have to step off from their tightening cycle at some point, and the bond market will eventually make a large rally, and amongst other things, and the market will come back. Worst case scenario right now, and I could truly see it happening, is it's kind of a three-pronged approach where inflation is moving up. They're continuing to raise rates at the same time, and then the stock market's also rising with it. And that's gonna be a very, very, very bad situation. And I truly hope it doesn't happen. But it's also possible because once the bond market gets too volatile, people are gonna have to, people are gonna want to move their money elsewhere. And what's the next most liquid market? The U.S. stock market. So if we catch a bunch of, flood, basically a flood of buyers coming from the bond market over here, the stock market, well, then you can see all three of these things happening at once, and that could turn really ugly. But
Well, I really appreciate your time tonight, man. This was a fantastic conversation. It's the kind of conversation more people should be having. And I really appreciate all the insight.
yeah, of course, man. Thanks for having me. It's always a pleasure to talk to you, man.
Yeah, man. I'm looking forward to next week, man. This is really turning out to be an amazing topic, amazing mentality to start thinking about, especially for the newer people. Like, I don't want them to feel intimidated by looking at macro level things. This is the kind of stuff that you have to learn about in order
Yeah.
to be successful and to be able to make an informed decision daily.
Yeah.
So I really hope that people latch onto it. I think they will. These are the kind of conversations that other traders are not having, and I think they should. So I really appreciate your time, man, and I'm looking forward to hearing and talking to you next week.
Absolutely, man. Thanks for having me on, and have a great night.
Absolutely, man. We'll see you later. I'm gonna go ahead and stop recording now, and we'll see you guys next week, gang. I'll talk to you later.